Part of the difficulty of trading in options is thinking that you're going to be getting a better deal by buying a lower priced option that is out of the money if you think there's going to be a big move in the stock. And in many cases, if there is a very large move in the stock, you are better off buying a out of the money put option because the returns can be dramatic. However, you have the risk of time. In many cases, an anticipated decline doesn't come about. So you're ending up purchasing out of the money put options that may expire totally worthless. The same thing with a call option. If you purchase an out of the money call option, if you're looking for a big move up in the stock and that doesn't happen, generally your option will decline dramatically. So even though you have maybe a small investment in that option, you will see your options decline in price as we get closer to the expiration date. There's a couple of points that I really want to make about call options and put options. In general, if you're buying an option, you want to buy as much intrinsic value as you possibly can. If you're selling options, you want to buy as much time value, you sell as much time value rather as you possibly can. In the strategies that we're going to be using, for the most part, we're going to be selling time value. That's what professional traders do. They will sell the time value knowing that for the most part, 90% of the time, markets, doesn't matter if it's a stock or if it's a ETF, will generally trade in a sideways consolidation movement. 10% of the time, stocks will actually trend. And so we want to play the odds. We want to play the 90% of the time in which stocks can just simply move sideways. Now, one of the biggest factors that we're going to be talking about whether or not we should when we should be selling options that are out of the money in order to generate income in our small frequent win, the SFW strategy, is by volatility. Now, we're going to be talking about the Greeks in a future video, but the most important Greek that we could focus on as we go through these strategies is volatility, is the Vega. Volatility and Vega are our friends. They can also be our enemies, but we're going to be using them in some unique ways in order to generate profits in the markets. In the small frequent win strategy, we're going to be looking to generate a consistent and reliable income from the markets. And we're going to be using Vega to determine when we should enter and exit our trades. Very important strategy, very important way to be looking at the markets. It's a more professional way to look at the markets. Most people trade on impulse, as I mentioned in the first video, and they trade on tips, and they also trade on rumors, and they trade on, and most importantly, they trade on the feeling that they have about the market at any one particular time. And that is exactly the wrong way to trade. You have to look at the numbers of your trades. You have to look at all of the factors that will affect your trade, and then use probabilities to determine whether or not you're going to be successful in any one particular trade. So these are options. If you have any questions about options whatsoever, we're going to be talking and using examples of options as we go through in the next video. I'm going to show you a little bit more about how time value affects an option, how options change in price if they're in the money or out of the money, as well as how Vega would affect an option's price. So this is a very basic introduction to options. Now, one thing that you need to remember is that when you purchase an option, when you buy an option, the most you can lose is the price of that option. So, for example, if you were to purchase just one of these December 11th 50 strike price calls, the most you would lose is the price that you paid for that option. If you sold an option, for example, if you were looking at selling one of these options for 11 cents at the 59 strike price because you didn't think the Qs would rise above the 59 strike price level, and you sold that option, and all of a sudden the Qs run up to $100, well, your potential liability and your potential loss could be unlimited because you are the seller of that option. You have to buy it back at any price that the stock was selling for. If you purchase the option, once it expires, once it goes below your strike price and there's no intrinsic value whatsoever in that option, your loss is limited and your liability is limited to the price that you paid. You have no further obligation. So it's very important to keep that in mind as we go forward, because remember, our number one rule is preservation of capital, and that's absolutely critical for us to be successful in the market. The second one is to wait for opportunities. We can't be jumping in and out of stocks and options on a regular basis, on a daily basis, and expect to make money. We have to wait for perfect setups. Okay, now in the next video, I'm going to give you examples of how options trade in real time and how they trade on a historical basis and how they change in price based on the variables that come into play with options, the biggest one being volatility, and we will go into that video in the very next sequence.